Well, what we have found is that a lot of the retail stocks have been bid up in anticipation of better sales translating into higher earnings. And we're starting to see some quite high PEs on those stocks. So we thought, well, what in this sector hasn't yet benefited from that phenomenon? And people, as you said, when they start to think that consumer confidence is picking up, they'll start investing in marketing. And so there's some stocks out there that have been in a constant state of earnings decline, which a lot of people have said it's structural. People are moving away from free-to-air TV. People aren't going to listen to radio anymore. And so they've derated the PEs of the stocks along with the earnings decline over the last 3 years. And so a stock like Southern Cross Media, which has problems with some of its personalities leaving the company, talking about Kyle and Jackie, which has led to people saying, well, they're not going to do so well in media in the metro market areas for radio anymore. They've had problems with ratings, and just the amount of advertising that's going into the sector has led to them to having pretty soft earnings for a few years. We're starting to see evidence that people will invest and they will put money back into free-to-air TV for advertising and into metro radio. It's still a very effective way of advertising. And sure, they mightn't pick up and get the rebound back to the halcyon days, but there will be a rebound, and so that's where we're seeing some relative value in it. 10 to 12 times and a 6.5% yield. We see that as being a better place than buying a retailer on 18 times.